market analysis and overview of key markets with Juan Maldonado and myself, Jody Samuels. Before we begin, I'd like you to just read this disclaimer to yourselves. Thank you. So today, we are going to do a current analysis of the markets. We like to do these monthly analysis webinars to keep you in touch with what we're thinking about the markets and to see what are the triggers, what's driving the markets. I think that's really important to get the big picture. So that's what this webinar is all about. So we will also show the wavy tunnel, the Elliott wave scanner, to see if the scanner is showing any trending markets. We'll discuss the best markets to trade right now, and since we are Elliott wave and Fibonacci specialists, we always do our analysis using Elliott wave analysis. And since Fibonacci is such a big part of it, you will also learn about Fibonacci. I'm not sure that some of you might be new to us and you might not know who we are, so I'm just going to give a brief introduction. So again, my name is Jody Samuels, and I first started working in the industry for a U.S. investment bank back in the early 80s. And during these last 30-plus years, I've always used Elliott wave analysis in my trading. And Juan and I have been working together for the last several years at FX Trader's Edge, which is a company that I founded about 9 years ago. And as you will see, Juan Maldonado is a very gifted Elliotician. He's our Elliott wave strategist. We only have one. He's it for FX Trader's Edge. And we also have other real estate on the net, ElliottWaveDesk.com, which I'll tell you about later, and ElliottWaveUltimate.com. So I hope you appreciate what we have to share with you today, and that you just might take away some.
Yeah, I was in a meeting with him last week, and as I said.
Right. So today we're going to start out by talking about the key market drivers, the fundamentals overview, look at the scanner trends, and focus on some correlations. And then I'm going to turn it over to Juan, who's going to do wave counts on oil, S&P, the euro, and gold. So we've picked those markets to get a smattering of stocks, commodities, and currencies. At the end, I'm going to give you an opportunity to join the Elliott Wave desk and get the scanner if you enjoy this analysis. But it is not going to be a sales webinar by any stretch of the imagination. Okay, so let's start with the big picture overview. And a lot of this is, we started to discuss last month in the webinar, so I'm going to carry through with the same theme. We discussed intermarket analysis and how it is really important to understand market correlations and what is driving the market. And at any point in time, there are different drivers. So currently, the drivers are U.S. economic activity and when the Fed will continue raising interest rates in 2016. In fact, that's today. Okay? That's this week. These are the drivers for this week. Other influences, China and oil. Now, one of the reasons why interest rate moves by the Fed have been on hold is because of the instability of oil for the last several months, or volatility, I should say, as well as the weakness in the Chinese economy. So, which much of the world relies on, they rely on China to get the rest of the world out of their doldrums. It's a global market, so looking at the U.S. in isolation is counterproductive. We have to look at the larger market forces. And the Fed looks at these global drivers as well. So with all the uncertainty in the global markets, the Fed put interest rates on hold for a while. But now I think we're at a turning point, and this is what we're going to discuss today. So certainly the Fed didn't want to move too soon to destabilize the global economic environment. They wanted to make sure that oil prices stabilize and that China has been doing something to promote growth in their economy, and they've been cutting rates. They've let the yuan weaken, and even at 6% growth rates, which to the rest of the world is rather high, is considered a recession in China.
Okay.
So we have to, take note of that. So with China stimulating its economy, that will fuel the global economy and global stock markets as well. With oil, the April meeting of oil producers will be important, and we talked about this last month. If they decide to freeze production by limiting production, theoretically oil should stabilize or move higher, and the opposite is true as well. So now that we laid out the big picture, let's review the big picture in charts and see the correlations grabbing hold of the market moves in today's environment. This is a picture that we showed last month. So this is updated as of the middle of February. And if we look at the red squares, we see that all the markets were pretty well correlated. Oil was a risk-off environment for that brief week. Oil was coming down, stocks were coming down. The dollar was dropping. Yen is considered, when the market buys yen, it's considered a risk-off trade. The euro was moving up, which is dollar down as well. The DAX lower, and gold higher. As you know, gold and the US dollar have an inverse relationship. So today, this is an updated chart, and I wrote risk off, which is the red box that we just discussed, and risk on with a question mark. Let's see what has happened within the green box over the last month. So talking about the first row, look at oil versus stocks. Now, this is not all stocks, this is just the S&P, and down below is the DAX. But oil and stocks have been moving higher. It looks like the S&P is highly correlated with oil in this picture, which means that as oil goes up, stock goes up, and vice versa. However, this isn't always the case if you look back over 25 years. So you will find periods of negative correlation, periods of positive correlation, and periods of no correlation. And right now, we're in a period of positive correlation. So why is the S&P following oil today? Maybe it's because rising oil prices in this environment is symbolic of oil price stability, and getting to a level that makes it profitable for companies to drill. And what does oil price stability do? It brings back investor confidence, which fuels the stock market. When the global economy improves and oil consumption rises, that will also contribute to a rise in the stock market. But we're going to take a look at the correlations in just a minute once we get through this chart. Looking at the dollar yen, the last time we talked about dollar yen, we talked about a strong correlation with the U.S. stock market historically, that when the yen when it's risk on, the yen typically weakens and the market looks to high-yielding asset classes, because yen historically has been a funding currency to buy stocks, to buy the higher-yielding currencies like the Aussie, the Canada, and of course now interest rates are down across the board, so it's a different environment. But look what happened with the stock market moving up. if one followed the reasoning for risk on, then the dollar yen would be moving up as well. And what happened? Well, the dollar yen stabilized. It traded sideways. So it's not that it moved lower, it traded sideways. Then if we look in the second row, let's look at the euro, the DAX, and gold. The euro has been mixed because the other side of the coin to the euro dollar, the dollar side, is the euro. So just as we are, the U.S. is looking to stimulate the European rates have been down, but Draghi commented that rates are at the low end of the range, and that's lending support to the euro. So that's why the euro stopped dead in its tracks down here at the 108 level and continued to move to test, the higher bound, even in a question mark risk on environment. I'm not saying that it's been a risk on environment. I'm just saying that oil has been going up, the stock market has been going up. But the euro certainly did not follow suit if we were looking at a straight dollar move. Right? If we go by the logic, with the euro moving up in this red box, the dollar moving down, the logic is that the euro would sell off and the dollar would move higher, but again, it stopped dead in its tracks right over here. And that's because the U.S. dollar is only part of the euro equation. Now if we move to gold, if gold is historically moved inversely with the dollar, the relationship held in February, but it didn't hold during this period right here. Okay, so what that means is that the markets the relationships might hold over time, but there are different correlations over time as well. So why don't we just have a look at that and see the correlations as they're happening right now. So this is a weekly S&P and oil, and you can see that looking at the weekly S&P versus oil, there are periods of negative correlation and periods of positive correlation. So in this period right here, I don't know if you can see my cursor, with the S&P moving higher, the oil is also moving higher. And then the S&P continues to move higher, and then oil collapses. So there's negative correlation here. That's the weekly. Let's look at the daily. So in recent months, going back to last August, oil seems more correlated with the S&P, which means that as the S&P moves up, oil also moves up. Here it's moving down, oil moves down. Here the S&P is moving up, oil moves up, and then this last little bit is the S&P moving down and oil moving down. So let's move in further and look at the hourly chart to see that, in fact, oil and the S&P are moving lockstep together. Just lockstep, you can see that. So that's what we have to go on this week. I mean, I'm sure the S&P traders, the stock traders, are looking at this relationship because it will give them clues as to what is going on in the S&P. And when Juan does a wave count in the S&P, you'll see what we're thinking with the S&P and with oil. Well, I thought this was interesting. Now let's look at the S&P versus the dollar yen. This is what we discussed last month. This is the slide taken from last month's February webinar comments. U.S. dollar yen, the yen crosses and S&P are a proxy for risk appetite. Dollar yen is mixed now, with Fed tightening on hold, pushing it lower, and risk on, pushing it higher. So sort of a mixed view on dollar yen. Maybe that's why it's been trading sideways. Continue to watch U.S. news releases to see economic improvements, albeit slow. Continue to watch oil, watch news out of China. So nothing has really changed since last month, other than the fact that now we're just getting closer and closer to perhaps the Fed moving, and this week will be telling, and we'll get into that shortly. And of course, Yellen is speaking in about 5 minutes, so the markets are might move as we're continuing on with this webinar. So this is the weekly, but now let's just drill down and look at the daily to see what has been going on between the S&P and the dollar yen. And this shows that whereas the S&P and the dollar yen had been tracking one another, in the last month, the dollar yen has been trading sideways. So will these markets once again align themselves, i.e. the S&P and the dollar yen, and which market is leading the other? That is key. So one could argue that, and these are the questions you can be asking yourself, is the dollar yen going to start to move higher and catch up with the S&P, or is this sideways price action, uncertainty with the dollar yen, going to pull the S&P lower? Finally, I want to take a look at gold and the euro, and obviously looking at euro as a proxy for the U.S. dollar. We could look at the U.S. dollar index, of course, but I'm just using the euro here as a proxy. And this is the daily. So again, we have periods of high, strong correlation and periods of negative correlation. And right now, if we just look at this last little piece on the euro versus gold, with gold moving down and the euro moving down, usually the relationship is gold higher, weaker dollar, gold lower, stronger dollar, and with the euro moving down, that is stronger dollar. So this is, in recent weeks, the price action that one would want to see if gold and the dollar were correlated. So right here, we have that relationship being followed. But in this piece right now, where we had the euro trading lower and gold trading higher, euro down, dollar up, the relationship didn't hold. So again, the other piece of the puzzle is what's going on in the Eurozone, and that's that's also to be considered, which we will discuss shortly. Okay, so just a note to continue to look at the correlations and know that the correlations are going to change from period to period. All right, now we're going to take a look at the scanner. And this was the scanner that we looked at a month ago with oil, S&P, yen, the same instruments, the euro, the DAX, and gold. And we see that a lot of the scanner is red, which means bearish. So we had the correlated markets showing in the scanner. Okay, so now what's going on with the scanner today? So this is the scanner as of today, and this is showing a very mixed market. And I think that's symbolic of what's going on this week, that the market is waiting for news, and we'll discuss that in just a minute. And as you see, the markets are moving now, but I don't want to be distracted. I want to continue with what I'm doing here. So the market is mixed. The only thing that is pretty consistent is that oil has flipped red, so oil has been trending down. Okay? We are having a massive move right now. All right. So scanner is mixed, but the scanner will I think it's going to show some trades. Oh, it's changing. This is just this is a screenshot from what I grabbed earlier. Okay, so I think I need to get to the news releases to show why Yellen's talk today is so important and why the U.S. the U.S. event risk is here right now. It's because of all the U.S. releases that have come out this week, some yesterday, some today, and some Friday. So yesterday we had core PCE price index. It was lower than expected, less than expected, meaning inflation isn't running away. Personal spending was lower than expected. Home sales were higher than expected. Today, consumer confidence, and that was much higher than expected. Okay? So all of these news releases this is exactly what the Fed is looking at. Are they going to start to raise rates in April or June? And most strategists had been looking at June. However, there have been some, some comments that maybe April is in the cards. So then we jump to Friday and we see the payroll stats. So Friday is going to be a very key day as well. Also on this page, we have all the Eurozone releases. So we're not going to talk about the Eurozone releases right now, but they're also very important because, again, if we're looking at the Euro-USD, it's not just one side. But this week, we're definitely, and today we're focusing on the U.S. releases. I think it would have been better for me to have done this earlier, not into Yellen's speech, but maybe this is timely. Okay, so let's just discuss this a little bit more. How is the U.S. doing economically speaking? The key is April or June, FOMC meeting rate hikes, looking for clues. Janet Yellen's speech to the Economic Club of New York is happening right now, and it's looking like with the euro moving up to 112.5 from 112, which means lower dollar. It's looking like she's saying that rate increases are on hold, until June. So again, we have Friday's U.S. Labor market report. Yesterday's U.S. personal spending and inflation measure were both weaker, as discussed, and U.S. consumer confidence rebounds. So as I mentioned, over the last week, there have been some mixed comments by a few of the Fed presidents that a rate hike could come as early as April, and that's why today's speech, Yellen's speech, is just so important for more clarity and for hawkish clues if that is the case. But we can see, I'm not even looking at her speech, I'm just looking at the price action, that maybe she's not as hawkish as the market was thinking that she might be. So on Friday, if the numbers are weak, then that will confirm what's going on right now. Dollar will sell off, and that's what it's doing right now. Gold will continue to move higher, and the market will think June instead of April for rate hikes. And it looks like it's thinking that right now. So, in summary, it's really important to understand what the drivers are. And the drivers for this week, as we mentioned, just simply the U.S., okay, keeping in mind everything else. So now I'm going to turn it over to Juan, and afterwards I'm going to give you an opportunity to join the Elliott Wave desk, but Juan is going to do an analysis on the four drivers that we discussed, namely the euro, oil, S&P, and gold. And he is going to show you our views and what the alternative views might be. So over to you, Juan.
Thank you, Jody. That was fantastic. Hello, traders. Thank you very much for being here. I'm going to explain the wave count that we are having on the euro, on the S&P. Then we will check oil and gold. The idea is that after this analysis, you will have a clear foundation for your trades. It's important to say that the Elliott wave count, just as a trading technique, is not going to work too well. What I mean is that you need also a strategy. We are going to work with some trend lines, but always it's important to validate the waves. We can have different scenarios or alternate wave counts, but at the end, the validation of the end of a specific wave is going to be the reason why we trigger a trade. Not just the wave count, but of course, the wave count, as you are going to see, is going to help us to understand the context of the market, to understand where we are, and the possible future scenarios. Very well, this is the EURUSD on the weekly chart. As you can see, the price is in a consolidation, or in Elliott wave terms, a corrective wave. The corrective waves are the most complex structures in the Elliott wave theory and in general in the markets. When a market is sideways, and sideways can be in a flat formation or in a triangle, is where you need to be more careful and get ready the best strategies that you have and trade, watching the market and being careful, extremely careful. Usually these sideways corrective structures happens during fundamentals. In the world is changing. We have a lot of information. From one side, the ECB was decreasing the rates. The Fed increased the rates on December. So a lot of information, and that's why we're seeing these markets and this indecision. In terms of the Elliott wave analysis, our main wave count is saying that we are inside of a triangle. This triangle is easy to see, where the price made a move up, then we have a retrace, then we have another move up. We are expecting to see the next move down for the D wave. So this is the leg that we think we are in, and then another leg up for the E wave, and then after that the continuation. So we are not going to worry about the continuation yet. We are going to focus inside the triangle. We are going to focus in what we are seeing, the structures that we are seeing inside the triangle, and how we can trade. I'm going to lower time frames in just a moment, and how we can trade those waves inside. Before I continue to lower time frames, it's important to say that this is our main wave count. But as you know, this week we have, at the end of the week, the non-farm payrolls and other fundamentals. So in case that the price starts breaking up the triangle line, if we start seeing a green candle, some price action to the upside, we can start activating a different structure for the corrective wave that at the end will mean the same, but is going to be just more as a flat. So what I mean, and I will show you that alternate wave count that I have on the weekly in a second, but what I mean is that the corrective wave until now is showing the structure of a triangle, but it could easily become a flat in Elliott wave, and that will mean something like this. But then we will go down. So the key fact is that triangle line. If the price remains below the triangle line and we start having some validation that I will explain on lower time frames, we are safe and we can trade to the downside. But the warning will come if we have that breakout of the triangle line, and in that case we will have the activation of this wave count that will be, instead of a triangle, an Elliott wave flat. So you already know what will be the trigger to pick this wave count or the other one. But let's continue with the main one. On the daily chart, what we are going to start seeing are the inside waves, because the Elliott wave theory says that the markets are fractal, which means that we have waves inside the waves and more waves inside the waves, and you can continue labeling and labeling according to the time frame from the weekly or the monthly chart all the way down to the 5-minute chart if it's necessary. The daily chart, as I was explaining on the weekly, we are looking to find this 3-wave sequence to the downside. As you can see, the structure of the price is complex. And today we are seeing the price retesting that weekly triangle line. So it's an important day because the euro is going up, and in case that on the daily chart we have a nice green candle closing above that triangle line, we can think that the price can go higher. But let's continue. Let's continue going down, because if our main wave count is correct, the structure that we will see will be something like a 1, 2, 3, 4, 5. So that's the Elliott wave projection. What we are going to find out on the 4-hour chart and the hourly chart is when and where to trigger the trade. Because again, just the Elliott wave count is not enough. We need to use other technical tools in order to find our trades, because we know that trading always needs additional validation. Let's go now to the 4-hour chart, because all the time frames are going just to give us more details about the setups, but it's going to be the same direction as the weekly and the monthly analysis, and that is part of the beauty of the Elliott wave analysis, that also provides all the information coming from higher time frames. Without the Elliott waves, it's going to be difficult to remember when you are on the 4-hour chart what the weekly chart is telling. But with this theory, you can have all the charts in all the time frames or the analysis. Very good. On the 4-hour chart, we have been trading the EURUSD in our services, extremely successful. We advise to our clients the direction of the market before the announcement of the ECB that caused that huge move up, and our target for that trade was the previous high. In my personal trade, I closed the trade at the 111.80. That was enough for me according to my strategy, but the direction was fantastic. And once the price completed that structure, we start calling the end of the B wave with some validations and the move down. We have a breakout of the channel. We have a breakout of the channel. The move down, the first structure down. Also, we suggest those shorts. And then we said, okay, that's it. And you may be wondering why we said, okay, close your trades. And the reason was quite simple, a trend line. When you are in a trend and the price break out the trend line, is because the trend is over. That easy. So in that moment, we said, okay, please close your trades. It was a nice trade around 160 pips. And now the price is retracing. And at this stage, we are watching, because in Elliott wave, always the corrective waves are the most subjective ones, because we have so many targets, so many Fibo levels. But the plan is to find the end of the wave 2. If you already have studied the Elliott wave theory, you may already found that when you are having a wave 1 and then you are waiting for the wave 2, the wave theory says that the wave 2 can retrace 38.2, 50%, 61.8, 78.6, 88.6, and also can invalidate the wave count. So in case that you try a strategy to short just because the price starts hitting a Fibonacci level and maybe you see a reversal candle or something, and then the price continues and invalidate the wave count, you are going to say, oh, this Elliott wave theory doesn't work. But actually, what is not working is the way that you are validating the waves. Always validate the waves. Do not trade just because the price hits a Fibonacci resistance in this case, or any other resistance levels. That's too risky. So how we can validate? We can start doing some trend lines, but first of all, let's go to the hourly chart, and we create our plan to validate the end of this corrective wave. Very good. The price seems that that didn't end the wave 2 yet, because the wave C is a 5-wave sequence, and right now we have only 3 waves. So usually what happens here is that the price makes a retracement and then another leg up to complete a 5-wave sequence. What we can find here in order to validate the bearish scenario is to start drawing a trend line for this 5-wave sequence. Once the wave 2 is complete, the wave 2 do whatever the price wants to do, but the validation will come when we have a candle close below this trend line. We also have a technique called the wavy tunnel that can confirm that quicker most of the times and easier than the trend line. But if you do not have a strategy, then the trend line can save your life, because, as I said, a wave 2 can invalidate, the wave 2 can be extremely deeper. What if the price wants to make like a retest of the old channel? A lot of things can happen here. So if you do not wait for the validation and just trade, I don't know, because you see a reversal candle or anything like that, then it can be extremely risky, because we have also the risk of the alternate wave count that I explained on the weekly chart. So you already know that, going back to the daily for a second, so you already know that if the price closes above the triangle line on the daily, we might see the euro going higher. So it doesn't have any sense to short at those levels. That is not going to give us any good trade. So that's the art of validation. The Elliott wave is fantastic. The Elliott wave counts are great, but always taking care of those validations, especially in these markets that are having a lot of fundamentals and a lot of things coming up. Very good. That's the analysis for the EURUSD. Now you have a clear plan for bullish and bearish scenario on the EURUSD. Let's continue with our next instrument, that is the S&P. For the S&P, we have been calling a lot of fantastic trades. On the S&P, I'm just going to do a quicker analysis, because I already have all my wave counts here and everything. But anyway, our analysis on the S&P has been fantastic, because we were able to find the bottom of the market. So what we did is that we start seeing divergence. Divergence is not the reason to trigger a trade. Divergence is part of the analysis. As you know, a market can be divergent and more divergent, and it doesn't mean reversal. But divergence with validation. In this case, we can have here our trend line. So more or less, that area was the confirmation that we use in our services to confirm the end of the bearish market of the S&P. So the price there confirmed the end of the bearish market, and it started to move up. We have been very successful during the move up by finding the end of each retracement and suggesting the next move all the way up, all the way up. But now at these levels, what we did today, for example, in our daily video, we said to our clients, start taking your profits if you keep your trade long open, because we're start seeing something that we do not like. There is divergence. Divergence, if you don't understand what divergence is, don't worry, but divergence is something simple. Divergence is telling that the trend is losing momentum. Losing momentum is that the investors are less interested in the market, in buying the market. That, yeah, the price is going higher, but is not a wave 3 in Elliott wave. A wave 3 is something like this. And also the oscillators are going with that wave 3, making more momentum, increasing the oscillator. And in this case, we're having the opposite. So in our wave count, in our service, we have been suggesting this as the full reversal of the market and the price starting the next bullish cycle. But because this concern and the breakout of the trend line, as I already mentioned, when you have a trend and the trend and the price break out the trend line, is saying that the trend might not be more in the trend. And if we're expecting a wave 3 here, this doesn't have any sense. That is why we have been telling that to our clients. So we have this wave count that is bearish, that the price could go lower. I will explain in a second how we can validate this, and also I will show you the main one that we have in our service, so we can provide you with a nice context about the market. So in that case, the price could easily make a new low. So now the question is, how we can tell, how we can know, where we can trigger, how we can have a trade plan in that case for this scenario. In favor of the bearish move is the divergence. So that's key. Divergence doesn't mean reversal itself, but it's a signal that the market is tired. On the hourly chart, let's talk a little bit more about the current price. So what we have is a structure down, and now we're having a 3-wave sequence up. If the price starts coming down and moving below this support that is easy to find, just looking to the left and finding the end of the leg down. If the price, for example, makes a move down like this one, and you see a red candle, that's important. The kind of candle that is making the breakout. If it's a nice body candle closing below the support, or if you like to go more conservative and you wait for a pullback to the support and like a failed attempt to re-enter to the previous area, those are different, of course, techniques, or you can have your own. That will activate completely our bearish wave count. So that will activate completely our bearish wave count. You already hear what Jody explained about the fundamentals. So this will be the technical explanation for that scenario. But the second scenario is the one that I already said that we were having active, that has been extremely successful. We are just getting ready for the future. And in that scenario, the bullish one, will start being active again if the price, instead of doing that 1, 2, 3 reversal that I just explained, starts making new highs. You see, so in that case, you are not going to lose money because you never trigger. Waiting for validations. So in that case, if this happens, the long bullish scenario will activate and you never trigger the short. In that case, what we will start suggesting to our clients will be to start being part of the bullish trend, because the oscillator for this alternative scenario will start increasing and will be stronger than the previous ones. And that's a signal that the trend is healthy. That's the green light that the market will tell us, hey trader, you can go with the trend. You can continue with the bullish trend. So there you have a nice perspective for both scenarios. And the next instrument we're going to cover is oil. Oil has been moving higher after finding that low at the 26 area. It started bouncing up, and the price is having some trouble to continue with the bullish move. We consider that this might be just a retracement and the price is likely to continue down after that. For now, we can't start worrying, we can start thinking too much about that medium-term analysis. I guess most of you are mainly day traders, swing traders. So for now, let's create a plan that we can use in order to find our next swing or day trade and the direction of the market. We think that the market still has bullish momentum. The oscillator is showing that the price is likely to continue. And now we need to answer the next question, that is, where we can validate, where we can find a high probability trade. As I already mentioned, a retracement wave is too risky to trade when we do not wait for that validation, because the price can easily continue and make a new low, and that's it. So if you are just trading with Elliott wave, you are going to say, if the price makes a new low, oh, that Elliott wave analysis doesn't work because it creates a new low. But again, validations is key. I'm sorry for saying that so many times. Anyway, our Elliott wave structure inside is showing a nice impulse for a C wave. 1, 2, 3, 4, 5 in blue. Currently, the price is making the last leg down to complete the impulse. We really like to work with divergence, and we start seeing that. As you can see, the market currently is divergent. But we are not taking the trade yet, because inside is pending the price to complete the 5-wave sequence. If you're a day trader, if you're a scalper, you can use this information to go to lower time frames and be part of the main trend. If you are a swing trader, then the strategy can be quite easy. Let's start playing around with trend lines. I'm going to take my first trend line from the previous high, then connecting the retracements. And I'm going to call this the main trend line for the corrective wave. Once we have the breakout of that trend line, we will have confirmation that the B wave ended. A conservative investor will trigger the trade right there. Of course, analyzing the kind of candle that made the breakout. You don't want to have a doji making the breakout. That will be an indecision candle. That's important. Okay, and a more aggressive investor could trace the trend line inside for the impulse and take the trade before. As you know, in trading, before means more money or more points, and more money or more points or more pips is also more risk. Less pips, more conservative, that will be the blue entry, is going to have less risk. When you trigger quicker with validations on lower time frames or faster validations, that is going to add more risk. So you also need to find out which kind of investor you are, and all the risk profile and all those things. That's important in order to have your technical entries. So mainly that's the plan for oil. Always knowing that the main trend on higher time frames is bearish, and that the market, once completes the structure, will continue down. Another tip that I want to give you when you are taking this kind of trades is always target the previous high. That is the easiest target. So you trigger there or there, and you take your profit at the previous high, because usually that's going to be a resistance, of course, and the price can make a double top. For example, that can be a scenario. So if you are expecting more and you don't manage your trade, that winning trade can become a loss. Also, after the level is going to be the market more divergent. So divergence doesn't mean reversal, but it's losing momentum. So a lot of things can start happening above the previous high. Then if you just take your profits here, you don't care what happens next. Very good. And now the last instrument that I'm going to cover today is gold. That is one of my favorite instruments to trade this week. So let's see the 4-hour chart, or actually let's go to the daily so you can see the main trend that is bullish. Gold has been moving up very, very strong with a lot of momentum. For example, compare this structure with the one that we talk in the S&P. This is an impulse. This is strong. This has momentum. If I add the S&P chart here, we will see something like the first leg the strongest, and then the next legs having a lot of trouble, and losing momentum. You see like the slope of the move? You see the difference? This is a strong move up. This is something like 1, 2, 3. The wave 3, a lot of momentum. This is a nice structure to follow. And the S&P was trying to move up, but that's why we're having our concerns, because the slope of the trend and the oscillators are not showing enough momentum. That's a nice structure to compare. Okay, so because gold has all that momentum, bullish momentum, what we can do? Analyze the retracement, analyze the sideways market to plan the next trade. What we have been doing is to analyze wave after wave, and in our daily analysis provide guidance to our clients. The price did the breakout of this trend line, and we start suggesting the bullish trades. The trade that we have been following here has been that a bullish trade already. This is a trade that we call the fill the gap for the people who took our advanced training, the wavy tunnel, and the trade is already hit the profit today. It's something called the fill the gap, and actually was the wavy tunnel was telling the investor to trigger before this trend line here. So we trigger around this level based on the strategy, and we already take the profits. That's a quick trade. But now here comes the next validation, and that candle is extremely important. That green candle. I just want to see the green candle at the close to see if the body is enough to think, okay, that's a nice breakout. Because in case that right now the price retrace and just leave the wick of the candle above the trend line, as you already know, is a bad sign. If everything continues in the way that we are thinking, if we continue seeing that the market is adding momentum to the bullish move, we will continue with our main target, the previous high, 1281. After that, we will check again and we will ask, okay, how was the breakout of that resistance? Is it good to continue with the next bullish trade? But at that moment, we already book the profit of our swing trade on that area. So that's the way. Elliott wave is fantastic if you learn how to validate the waves. Do not try to use Elliott wave itself. It's going to give you a lot of wrong signals, and you will be using the Elliott wave theory in the wrong way. So thank you very much. Now back to you, Jody.
Thank you, Juan. And that was terrific. And I know you guys got a lot out of this. So I just want to show the 6 markets that we've been following and just talk a little bit about Yellen's speech and then show you the Elliott Wave Desk. Actually, why don't I just show you the Elliott Wave Desk link now in case you want to join us after that terrific wave counting that Juan did. Just check out fxtradersedge.com/EWD. Maybe we can post it in the box. fxtradersedge.com/EWD. And let me just take this and post this. And then I can continue on. There we go. Okay, so let me just okay, so I hope you can see my screen here. This is the same 6 markets that we were looking at earlier. I have the hourly charts up. Oil, S&P, dollar yen, euro, DAX, and gold. So what's happening, the original relationships are holding here. Oil up, S&P up, dollar down, so dollar yen is down, and the euro is up, which means dollar down, and gold higher. So what has caused this? Let's look at the article. Okay, this is from CNBC. It's a Reuters article. Guess that came out. It came out about 12:30 or 12:25. So this is key. It's appropriate for the Federal Open Market Committee to proceed with caution in adjusting policy, Yellen said, acknowledging that economic and financial conditions are in some respects less favorable now than in December. So she really put a stop to the talk that maybe rates will increase in April. And this comes out below where it says, still, since then, several Federal Reserve officials have said publicly that a rate hike could be coming soon. Fed watchers had consequently expected Yellen to lean dovish in Tuesday's speech to battle markets' expectations of an impending hike. So there you have it. We're still waiting for non-farm payroll to come out, but in the meantime, the market has a bit of direction. And we really appreciate your being here today. Thank you so very much. Again, fxtradersedge.com/EWD to join us in the daily wave counting service. and we look forward to speaking to you again next month. Thank you, Juan. Thank you, everybody. See you next month.